Okay, other income. Like I showed you on the Schedule 1, there are lots of different categories of other income that's on that page 1 of the Schedule 1. These are just some examples. There's all sorts of different types. Remember, all income is taxable unless it's explicitly excluded. So jury duty pay. Jury duty pay is taxable. However, if you get to keep it, it's taxable. If you have to pay it to your employer, so a lot of employers will give you jury duty off, and they'll pay you for your regular day, but then you have to hand over any amount that you get for jury duty. Then it's just kind of in and out. You don't have to pay tax on that because you didn't actually receive it. The mileage reimbursement that they give for jury duty, though, is not taxable. That's separate because that's a reimbursement for expenses. Prizes and awards, usually, depending upon the value of it, it's gonna be included on the W-2, the value of that award is gonna be. So, like, for example, a lot of salespeople get like vacations as awards. So if the value of that vacation would be included as taxable income on their W-2. So yes, it was free, but the IRS wants a cut of income you never got. So, forgiveness of debt. I think you have a question on your homework about forgiveness of debt, so I will go through this. So forgiveness of debt, this is when you borrow money and then it gets forgiven. So you got a big credit card bill, you negotiate with the credit card company and they decide to cut you some slack. Maybe you owed them $20,000 and they agree to take 10% of that, $2,000, and then they wipe out the debt. They figure it's better to get $2,000 than nothing, which is what they probably were gonna get ultimately. I'm not saying you personally, but you know. So you have $18,000 of debt forgiven in that case. That is taxable income because you're economically better off, right? Now there is an exception, and there are several exceptions to this. One of them is insolvency. So insolvency, if your liabilities exceeded your assets immediately before the debt was forgiven. So think financial accounting, think your balance sheet. You have negative equity. Your liabilities immediately before the debt was forgiven. So that means you get to include the debt in that. Then the amount of debt that was forgiven is not taxable up to your insolvency. So if you were insolvent, like you were $5,000 insolvent, that $5,000, now you only have to pay tax on $13,000 of that $18,000. It gets reduced. Okay, so that's the most common way of avoiding debt forgiveness. And I mean, to be honest, most people who are at a point where they actually are allowed debt forgiveness are probably insolvent. I mean, they're probably, the creditors have gotten to the point where they understand that they're not going to get much out of you. So, but that is considered to be taxable income if you are not insolvent. And I don't know that they don't really talk about insolvency. When the taxpayer is insolvent, that's all they mention there. But that, in my experience, in my practice, that was the most common way. Certain insurance proceeds. So if you receive insurance, most insurance, no, because even life insurance is not taxable. So the recipient of life insurance does not pay any tax on that income. However, if you cash in a life insurance policy and the amount of cash value is more than what you have put in premiums, then the amount that exceeds what you put in is taxable income. Any proceeds in excess of the adjusted basis of the property insured as well must report taxable income equal to the excess. So in this case, what they're talking about is, let's say your house burned down and its adjusted basis immediately before it burned down was $300,000 and you received $400,000, you actually have a gain there of $100,000 on the value of the property. So in that case, that $100,000 would be considered taxable. Questions?
are these things that information you would gather from the client, like it doesn't come like in the mail for like jury duty, like a separate form from like the government, right, or does it?
No, that one doesn't. Normally what happens is like practitioners will send out questionnaires to clients early in tax season or even before the end of the year that addresses all, it will be like, and the software companies put them together. And they will address, you can make it as detailed as you want or as general as you want. The more detailed it is, of course, the more cumbersome it is, but the more you have, the more substantiation you have that you asked all the questions. So it would have questions on there about, did you, during 2024, did you have any debt forgiven? And then, you know, at least those yes or no questions, then the practitioner can ask further clarifying questions. So if they put yes, then you would go into, okay, let's talk about this debt. What happened? What, you know, were you insolvent? Were you, and that sort of thing. Does that answer your question?
Yeah, so it's kind of self-report.
Yes. So if a client doesn't tell you, now the forgiveness of debt, they actually will receive a 1099-C from the, so like in my example, you get a 1099-C form, which is for cancellation of debt in the amount of $18,000. So that would be a trigger for them. Now, of course, the practitioner always is depending on the open, honest answers of the client. And that's all that they can depend on. So like some of these others, like you said, jury duty pay, yeah, there'll be a question on the questionnaire about it, but if they check no, or they leave it blank, I suppose if they leave it blank, then the practitioner really should have them answer that question. But you only know what they tell you, right? Yeah. And that's all you're liable for as well. But you do have a duty to exercise due diligence and to ask those questions, so. All right. So those are other types of income. We'll go on.